rules. Money rules. Money. Welcome to the Money Rules podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
Today we're unpacking a topic that affects millions of South Africans: debt. But not just the obvious debt. We're talking about the hidden costs of credit cards, personal loans, and overdrafts, from interest that creeps up on you to sneaky service fees that drain your account. Joining me today is Hannah Myberg, a certified financial planner at Crew Invest, who will help us decode these costs and what to look out for before signing on the dotted line. Welcome to the podcast, Hannah.
Thank you so much for having me today.
Hannah, let's start with credit cards. They can offer up to 55 days of interest-free spending, but what catches people off guard with that?
So typically what catches people off guard is that interest-free bit. So the way they structure it is that the interest-free period is only applicable if you pay the full balance due every month. So what catches you is that if you carry over a small amount that is unpaid, the interest starts accruing from the date that you made the loan or took a date of the purchase, and not just from the due date of the repayment. So it's not like a rolling grace period. It only resets once that full balance has been cleared. So you've got to watch out for how much is due and when.
And what are some of the fees people tend to overlook with credit cards?
Yeah, so there are different fees with credit cards, but it's important to look out for any activation fees. So often with these products, you need to activate the product, especially with new accounts. So it's important to understand how much that's going to cost you. And if there's any fees if you go over your limit. So there might be fees charged if you spend more than you were supposed to spend in a certain month. And often people take out credit cards when they go traveling overseas or if they're shopping online overseas. So something to look out for are transaction costs when swiping or using your card overseas.
Hannah, what happens if someone only pays the minimum balance to their credit card every month?
So this is a tough one because the word minimum often makes us feel as though you're doing what you need to do, but you fall into a trap and you end up with long-term debt. So when you pay the minimum payment into a credit card every month, you only cover some of the interest. So your actual debt doesn't actually continue to decrease. So it's almost as if you're not moving forward with the actual outstanding amount. So it kind of lingers on longer than it needs to. So that's quite a tricky one.
Now, overdrafts are often marketed as a safety net, but can be surprisingly expensive. What are the real risks of relying on an overdraft facility?
Yeah, overdraft facilities also catch people. But the biggest risk there is that you look at this overdraft facility and you use it as though it's part of your income. Remember, with credit cards and overdraft, this is money that the bank is loaning you, assuming you're going to pay it back. So overdrafts have a high interest rate, and it is money that you will need to pay back from your next salary. So it almost gives you this sense of, or this false sense of security every month where you are overspending and then you end up with a higher amount in overdraft every month.
Are there monthly fees even if you don't use the overdraft?
Yeah, so when having an overdraft facility, the banks often charge like an access fee to have this overdraft facility. Obviously, it is very helpful to have an overdraft because there is funds available if you don't have any funds. It's just important to be disciplined and to understand that the minute you dip into your overdraft, the interest starts accumulating. So you almost have to have a plan to pay back that money in the overdraft immediately.
Let's move on to personal loans. These are often promised quick cash. What fees should consumers be aware of before taking one? And are there any other factors they should also take note of?
So with a personal loan, similar to other loans and credit facilities, there's a monthly service fee. So that's typically a rand amount that's charged every month that you do still have the personal loan open. There might also be initiation fees to open up the personal loan or to get the personal loan in the first place. And then it's important to see if they've added any, or the bank's added any credit life insurance to this personal loan. So credit life insurance essentially covers you if you pass away. So it pays the bank back if you were to pass away. So it's good to understand what the total cost of the credit's going to be every month and not just the monthly installment for the debt that you've taken out.
I'm just staying with the whole credit life insurance. Is it always necessary, or is it sometimes a rip-off?
That's where it's important to, consult with someone or a financial planner or professional just to understand what existing life policies you might have in place already. So someone might already have life cover in their personal capacity, and now the bank is insisting on credit life insurance, or they've added it to your premium to kind of boost profits on their side. So it's important not to accept this cover without asking questions if it's compulsory and if there's other pricing options available. If you do take it, you might end up with life cover on your credit and life cover in your personal capacity.
Now, Hannah, there's often confusion between the nominal and effective interest rates. Can you explain the difference and why it matters?
Yes, of course. So the nominal interest rate is often what's advertised on the poster or online or on your banking app. So it doesn't take into account how the interest is charged. So when you want to compare the real cost of borrowing, you need to look at the effective rate. So the effective rate will include compounding over the period that you take out the loan or incur the credit. So it's good to always ask for the effective rate and not only compare nominal rates.
Hannah, in your opinion, do people really understand what affordability means when taking on debt, or are we just told what we qualify for?
Yeah, so I think this is a tough one and often argued by many, but they call it affordability, but it's actually what we do qualify for. So affordability would take into account future plans. They would look at it on a personal basis. So they would pick up your file and go through, what does this look like? What is this person trying to achieve? And then decide what their affordability is. Whereas what they do is they call it affordability, and they essentially take income minus existing debt and see what debt you can incur further. So that can be a little bit tricky because it's very narrow. And if we look at true affordability of clients, it would need to look at their personal situation and see what their plan is with their debt repayments.
What red flags should people watch out for when applying for any kind of credit?
I think it's tricky out there with lots of scams. So it's important to make sure that it is a legitimate offer. So make sure that you're not paying an upfront fee to receive a loan. That's often a scam. Don't feel pressure into signing immediately. So make sure that you read through your T's and C's and don't just tick the box at the bottom. So understand exactly what you're signing up for. And then just understand what other benefits come with the credit. So often banks are advertising benefits that come with using a credit card, but understand if these benefits are applicable to you. And then often store cards are given or approved too quickly without doing proper checks on affordability. So it's good to just double check in with, either a planner or a friend just to make sure that you understand what you're signing off on.
And are there better alternatives for those who need quick cash without getting trapped into a cycle of debt?
Yes. So if we look at the broader planning, if you already have a bond on your property that you're repaying every month, there's something that you can do there where you can access extra cash that you've put into your bond. So this is a way of getting access to money at a much cheaper rate than you would through a credit card. So you're essentially borrowing money from the existing bond at the existing interest rate. So that's an option. You can also reach out to families and see if they're able to loan you money at a more favorable interest rate. But I guess the thing here that saves everyone is establishing an emergency fund. So an emergency fund is there to help you when you do need quick cash. So having that in place, even if you start by saving 200 Rand a month towards a fund, then at least you know you don't have to dip into credit before looking at your emergency fund.
Just lastly, what advice would you give to someone who already has multiple debts and is struggling to keep up with payments?
Yeah, so this is a tough one, and I think a lot of people struggle with this, and it's almost as if you don't look at it, it doesn't bother you, but that's probably the worst approach. So it's probably a good idea to get in touch with a financial advisor or someone that can hold you accountable for these debts. So there's various methods of getting out of debt. So there's something called the snowball effect. So that's where you pay the smallest owing balance first. So this can be quite motivational because you knock off the smaller ones quite quickly. So you have a less debit orders or less repayments coming off your bank account. Then there's what we call the avalanche approach. So that's where you pay the one with the highest interest rate first. This is mathematically optimal. So this is the way you would pay the least amount of interest over time. So also a good method. Again, it's going to depend on what's going to motivate you the most to get this sorted. You could also look to consolidate your debt. So look at applying for one big personal loan and pay off the little store accounts or anything else that you owe, or a credit facility. With this, obviously, you're just consolidating. So you need a lot of discipline to stick to the plan. And then you can also look, depending on the credit provider, to renegotiate the interest rate or restructure the repayments in a way that's more affordable for you. But essentially, it's going to start with behavioral changes, stop overspending, and have someone that holds you accountable.
And that brings us to the end of this week's episode. Thank you so much, Hannah, for joining us.
Thank you so much for having me.
That was Hannah Meyerberg, a certified financial planner at Crew Invest.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Moneyweb, your trusted source for business and investment insights.